Michael, thank you so much for joining us today.
Thank you so much for having me back on.
All right. Now, this week we have viewers' questions for you. One of them is about the yield curve, and the viewer is wanting to know why you think the yield curve is flattening, and also how long can this continue?
Well, why do I think it's flattening? Because it is flattening. So it went from 2.6%, 260 basis points back in 2015 to just 41 beeps as of yesterday. So it is flattening. And the reason why it's flattening is the same reason why it always flattens, because the Federal Reserve is raising interest rates on the short end of the yield curve, the Fed funds rate, the overnight interbank lending rate. So that's the only rate they directly control. That's raising interest rates on the short end. Of course, they're also selling their balance sheet, $30 billion worth of mortgage-backed securities and treasuries. They're burying, so just taking that money out of the system, burning it, and they're putting those bonds onto the public. The Treasury has to then sell those bonds to the public at a fair price. So you're looking at deflation, a deflationary force, which is the destruction of money. And raising interest rates is also deflationary, right? It's because you could curtail the amount of bank lending. So if inflation is going to fall in the future, long-term rates would come down. That is your flattening of real curve from 2.6%, 265 basis points, to just 0.41% as of yesterday. Today it's a little higher, but the general trend is for a flat to inverted yield curve. And I hasten to mention that the Federal Reserve is supposed to hike rates 2 or 3 more times this year, Elijah. So, but the spread between the 2-year and the 10-year is just 45 basis points. Well, you don't have to be a math genius to understand that's by definition. If they do go 2 more times, that's an inverted yield curve, assuming that spread between the 2-year and the Fed funds rate maintains its current spread.
So what does this mean if we're going to see this inverted yield curve? What does this mean for the financial system?
Well, it means that banks don't get paid to lend money out anymore because their deposits are costing them a certain amount of money, and their loans are their income from these loans, what they generate on the long end of the yield curve, is costing them is income to them, not costing them, but it costs their customers. But if they're paying more to their customers that are depositing money than they are to their customers that are giving them money, they don't really want to make more loans. So they're upside down on their balance sheet. What that means is that the money supply shrinks rapidly, and always when the yield curve inverts, always, you get a recession within about a year, hence from the inversion. So that's where we're headed, I think, late 2019, because I think the yield curve will invert later this year in October. You're probably looking at a recession sometime in the fall of 2019. Of course, the stock market doesn't wait for an absolute recession to be declared. It'll sell off way ahead of time.
Now, this viewer is wanting to know about what they call a bond apocalypse, and if you see a bond crisis coming in the future. They ask, in what ways is a forthcoming bond apocalypse likely to be international?
Well, if you believe that the Japanese government has a right to issue 10-year notes at 0%, then you don't think there's going to be a bond apocalypse. You think that that's normal. And if you think the German bund should be yielding 0.5%, you don't think we have a bond apocalypse coming. And even in the United States, we've got the 2-year note at 2.8%. This is historically the most mispriced asset in the history of the world, in the history of economics. There has never been a more unbalanced, warped, distorted price in the world than the price of bonds. And as I said, if you have a country such as the nation of Japan, which is really just a retirement village, and they have a debt to GDP ratio of 250% on the national level, and they have an inflation target of 2%, and yet they are somehow able to issue debt at 0%, it lets you know that once central banks get out of that money printing business, and the United States is out of it, we're now draining the balance sheet. to the tune of $30 billion a month, going to $50 billion come October. The ECB is almost out of it. They'll probably cut in half their purchases in October from 30 billion euros to 50 billion euros. And I guess sometime in the future, Shinzo Abe and Mr. Kuroda over there in Japan are going to have to reduce sometime in the future. Otherwise, their yen will absolutely collapse. They're going to have to attenuate those purchases. So once that occurs, that is your yield shock. Now, I will hasten to add to you that we've already had a yield shock because the Fed went from 85 billion a month on QE to zero. They're draining their balance sheet. Guess what happened on the way to that maneuver? LIBOR, the London Interbank Offered Rate, which is the dollar cost of loans over in Europe, 3-month LIBOR, went from 0.3% in 2016 to 2.36% today. So that's a huge move in the cost of funding $370 trillion worth of loans and derivatives. So we've already had a yield shock. It's already happened. And the U.S. 10-year went from 1.3% to 2.8%. So the yield shock has already occurred. And the question is, here's the big question for investors. And I don't even have the answer myself. I know that this is historically the most unusual anomaly ever, as I mentioned. But here's the question. Is the yield shock over? And are we going to have this inversion of the yield curve and a recession right away? Or do we have a little bit room left more in the rising of global bond yields before that occurs? And then you have to ask yourself this question. If we have a recession, Elijah, and the deficit in the United States goes from what it is for the fiscal 2018, around $1 trillion, fiscal 2019, 1.2 trillion. If those deficits go to $2 trillion per annum, and there is no Fed QE, let's just assume the Fed doesn't get right back into quantitative easing, what will happen to those interest rates? Because normally during a recession, interest rates go down. But really, I mean, $2 trillion of deficits in 1 year? It never has happened before. So deficits as a percentage of GDP would be close to 10%. Who's going to buy all this debt? And so, you have to ask yourself, what's going to happen to yields? And I do believe, by the way, the Fed eventually has to come back in and purchase all this debt. But when? How do you trade your account? How do you manage money? That's where I come in. That's what I think I do very well.
Now, this viewer actually is wanting to know about the U.S. government debt and also the U.S.'s monetary policy with regard to comparing it to Japan. They're saying, it seems like Japan has gotten away with really low interest rates, a lot of debt. Why can't the U.S. get away with that as well?
Well, first of all, you have decades worth of deflation in Japan. We don't have decades worth of deflation here in the United States. That's one of the big trenchant differences. Also, as I mentioned, Mr. Abe and Mr. Kuroda at the central bank in Japan, they are purchasing their bonds. They own almost all of their bonds. They own over half of all the equities there. So it's completely manipulated by their central bank. So I guess if you're asking me, could our Federal Reserve go back into QE and keep those bond yields low in the United States? Well, I guess that's possible. But if you had a central, let's just say that that's the case, that we have a recession, deficits go to $2 trillion per annum, the Federal Reserve has to lower interest rates to zero and then go back to the printing press, and they start purchasing $200 billion a month of treasuries. There is a chance that yields could stay low in the United States. Treasury yields could stay low. But we already have a case, and look at the Philly Fed that came out this morning. The Philly Fed showed that prices paid index absolutely exploded. The prices paid index on the Philadelphia Federal Reserve manufacturing index. We have a condition here now, you're going to, in this scenario, where the Federal Reserve has to admit that we can never normalize the balance sheet. We can never allow interest rates to rise because we just couldn't service our debt. And if that's the case, maybe Treasuries stay low because the Fed will be buying everything issued. But what would happen to municipal bonds? What would their rate be? Because you're talking about intractable inflation. What would junk bonds be? I mean, everything that the Fed wasn't actively buying, everything that they weren't active, every fixed income instrument that the Fed was not actively buying would explode higher in yield. And that would derail the entire economy. So, I mean, think about what I just said there. That's a very dangerous path to go down, where a central bank says, I can never normalize interest rates. I can never drain my balance sheet. I can never never defend the purchasing power of my currency ever again. That is a tacitly admitted statement from the Fed if we have a recession in the next few quarters and they go back into QE. That's a pretty big hurdle for them to leap over.
Now, this viewer, it's kind of a follow-up from the question of one of the previous questions. This viewer is wanting to know, how can medium to small investors navigate this bond apocalypse?
Well, you can forget about the modern portfolio theory of investing, dollar cost averaging, and buy and hold, which is the major mantra from Wall Street. You have to be much more nimble in the upcoming default scenario. Central banks across the world are going to aid in the default on this debt, sovereign debt, pension plans, you name it, any kind of fixed income instrument is going to be defaulted upon, especially on the sovereign level. And that includes municipal bonds, that includes junk bonds. And what kind of default will there be? There'll be a restructuring, deflationary default, where they actually tell you, hey, pensioner, you're going to get 50% or some X percent of what we promised you. That goes to the government entitlement programs as well. That could be a deflationary default, and you have to invest completely differently. Your portfolio has to be completely differently hedged during a explicit deflationary default. On the other hand, as I said before, I believe central banks will not try that until they first go down the inflationary route. Okay? And that means that what they're going to do is they're going to print massive amounts of money, trying to control the bond market and try to bend down that cost of money across the globe.
This viewer is wanting to know about the U.S. government debt and what it's really composed of. Like, is most of the debt, they ask, long-term, 20 to 30-year maturity and not rolling over in the near future, so rising interest rates won't really have a major impact? What is the U.S. debt composed of? Oh,
in the United States, it's very short-term. It's about 2 years in duration. I don't have the exact duration, but as a matter of fact, many people have pushed for longer duration bonds. Jack Lew was pushed to do it. Many Treasury secretaries before him were pushed to do it, and even our current Treasury Secretary, Mr. Mnuchin. They all declined to do it. They have all opted to have this kind of adjustable rate mortgage where they're saying, listen, we can't float 30-year bonds or 50-year bonds or 100-year bonds in size the way we need to, because the yields, we would just, we already have a deficit of over $1 trillion, and we've gone down the duration spectrum. So what happens is, as yields rise, we have to roll over that debt much more frequently. So it becomes, like I said, an adjustable rate mortgage, and a very dangerous one at that.
So right now it seems like we're in a very dangerous situation, as you're saying. If a lot of this debt is very short term, then if interest rates rise, then the U.S. government will have to pay more, really higher interest rates in the near future.
Oh, yes, absolutely. I mean, if you look at the deficit now, the deficit's already running per month. We had a deficit in April of over $200 billion. In 1 month, $200 billion deficit. Now, if you go prior to 2008, prior to the Great Recession, the annual deficits were just billion. The annual deficit, we're doing that every month now. In fact, the first 6 months of fiscal 2018, the deficit is $600 billion. We're on pace for 1.2 trillion. They say it's going to come in at the end of the day at a trillion. But a lot of that is interest expenses. You know, we could be paying 30 to 50% of all of our income just on interest on the debt in the next few years at the rate we're going. So we're in a lot of trouble. Don't believe, you know, turn off CNBC and Bloomberg. Bloomberg's a little better than CNBC, I have to admit. But these programs should be listened to on mute because, you know, if you listen to these people, global growth is accelerating. Well, not really. If you look around the world, you know, the Shanghai Composite Index is down, I think 4% on the year. The Nikkei is down. The Morgan Stanley Composite Index for the globe is down on the year. The S&P 500 is unchanged on the year. All of the global purchasing manager indexes are rolling over and falling. So, you know, it's globally synchronized recovery management from Wall Street is way back in the rearview mirror. We are slowing down as a globe. And when you slow down as a globe, your revenue slows down. And as you know, we've had massive increases in expenditures on the sovereign level. So there's a big disconnect here, big mismatch. That's part of the yield shock. It all depends on what central banks do. Do they allow this yield shock to continue, or do they try to manipulate it to the downside? There you go. That's your binary choice, inflation or deflation. Default is coming. How we default is paramount to determining how you invest.
All right. Well, Michael Pento, thank you so much for joining us today. Before we let you go, are there any last thoughts you'd like to add, and where can our viewers find you online?
So you can find me online at pentoport.com. You can email me directly at mpento@pentoport.com. The office number here is 732-772-9500. I'll leave you with this. You know, we have an earnings growth here in the United States of approaching 20% year-over-year earnings growth. And what Wall Street likes to do is extrapolate those earnings in a linear fashion, a linear trajectory out for years on end. That's not the case. You know, at the end of this year, towards the fall and the end of this year, you're going to see earnings growth, instead of double digits, is going to be probably falling. If I'm correct about the inverted yield curve in a recession, you're going to have earnings growth, nominal growth rate in earnings falling. And you can't slap a 22 PE ratio on reported earnings in an environment of a recession. You know, the PE ratio should be more like 10. So my advice to you is there's a confluence of events in the fall, and I'm talking about the apex of reverse quantitative easing, reverse QE, quantitative tightening at $50 billion a month. There's a salient chance, unfortunately, that the Republicans could lose the House of Representatives in the fall. There's a good chance that Mr. Over the ECB, Mr. Draghi, will cut his ECB program in half in the fall. The Federal Reserve will have raised rates two more times. It is going to again in the fall. So there's a tremendous confluence of events happening in the fall, which would lead me to tell your listeners and your audience, please find yourself a strategist that can help you navigate a bear market, because a bear market, which we haven't seen in 10 years, is coming, and this bear market is going to come fraught with a new set of challenges and opportunities. So the challenges, just briefly tell you, balance sheets across the world are stretched. Government balance sheets are stretched. Individual balance sheets are stretched. Corporate balance sheets are stretched, and central bank balance sheets are stretched. So this next recession is going to be unprecedented in proportion, and you still have a few months to prepare.